Welcome to Bloomberg Technology. I'm Emily Chang, currently sheltering in place in San Francisco. Uber posting its first ever decline in its ride-hailing business. This showing the COVID-19 pandemic continuing to wreak havoc on the on-demand transportation business. That said, markets ending the day higher, tech giving them a bit of a boost. This as unemployment claims continue to soar to record levels. 3 million more new jobless claims this week, bringing the total to 33.5 million jobless claims filed just in the last 7 weeks. I want to dig now a little deeper into these Uber results. Uber inching closer to a profit despite these bad numbers in the ride-hailing business. I want to bring in our Taylor Riggs, who's been following the story. Taylor, let's dig in a little bit here. Obviously, shares actually spiking after hours despite not good results when it comes to ride-hailing in particular. The business boosted a bit by Uber Eats. How do you break it down?
Yeah, Emily, I think what's key here is you got on the analyst call. The Uber CEO said the rides are rebounding strongly in places like Georgia and Texas, where sheltering-in-place rules have been eased. He also said, Dara Khosrowshahi, that he sees green shoots in demand recovery. And then this was the news that I was waiting for. The CFO has just come out on the call and says that he does see profitability in 2021. Remember, both Uber and Lyft have been aiming for those profitability targets. All the analyst notes I read this morning said that, frankly, as it comes to Lyft, they weren't going to even be looking at profitability until the first half of 2022. So I think to get some guidance from management on the call about maintaining that profitability target in 2021 is very key. That's exactly when you saw the stock reverse from what was a 3% drop earlier up to now, an 8-9% gain or so. Let me just walk you through some of the numbers because the loss that...
Go ahead. I wanted to actually jump in and mention that the business also getting leaner as a result of some of the layoffs that they're making. They just announced laying off 14% of the company, and Dara's memo to the company about these layoffs indicated that there will be more. So you wonder if this smaller and leaner Uber going forward helps get the company to that profitability that they're shooting for.
Yeah, you are exactly right. In terms of the cost cutting that they're having to do, still though, I would note the magnitude of the losses that they had in the quarter. If you just look at adjusted EBITDA, they had a loss of more than $600 million. That was a little bit better than expected. But if you include the write-downs on investments that they saw for the business, $2.9 billion of losses. That's triple the loss of a year ago. Some of that is the write-down of a stake in Didi, for example. So you are going to see them, and I know that you'll be talking about this next on your show, offloading, for example, their bicycle and some of their scooter businesses to Lime. So they're trying to offload, I think, some of these assets, and as well as look at the cost cutting that they're doing and the write down on the investments, because this is having a staggering loss on their income state, almost $3 billion, again, triple what it was before. But again, furthering those cost cutting measures to eventually see that profitability come by about 2021 or so.
Right. We're actually, we've got Wayne Ting, the CEO of Lime, waiting in the wings to chat with us, Taylor. But before we do that, what do you think about Uber versus Lyft? We covered Lyft earnings earlier this week. Lyft, of course, a smaller business, but then perhaps less exposed. Investors were also excited about the numbers there, just perhaps not as bad as some thought they could be. Do we have any more clarity now about whether Uber or Lyft is in a better position to weather this pandemic?
I think the key here is that you saw the Uber Eats bookings business crush it. They were growing 52% to $4.68 billion. That was $300 million more than expected. And that really helped them despite a decline in some of the ride-sharing business. So this is the case where the diversification of the business, having that Uber Eats business, is actually going to help them. Coming into this report, there were some concerns given that Uber came out and said that they'd already started experiencing revenue losses in January, in February, given their exposure to revenue in their Asian region. And analysts actually were more optimistic on Lyft, given that they were only tied really to the North American business, and revenue only started to decline in March. This might change the game, though, now that Uber Eats business did so much better than people thought. It really is that geographic and the different business line that really could help them going forward. I will say, though, that profitability could be a game changer, given that analysts thought Lyft might not now be profitable till 2022. If Uber can stick to that goal in 2021, that could be where you're seeing Uber has more levers to pull to get to that profitability sooner.
Interesting. All right, Taylor Riggs for us in New York. Taylor, thanks so much for breaking it down. We're going to dive into Uber's results further later in the show with Pierre Ferragu of New Street Research. But meantime, I do want to bring in Wayne Ting, the new CEO of Lime, on this news that Taylor mentioned. Uber leading a $170 million investment round into Lime, the scooter and bike sharing startup, and also offloading its own scooter and bike sharing business, Jump, to Lime. Wayne is with us now. So first of all, Wayne, you're replacing Brad Bow as CEO. You've got this new infusion of capital after you yourself have had to lay off several staff around the world. What does this new money allow you to do?
Yeah, first, thank you so much for having me. I think today is a big day for micromobility and certainly for Lime. I think this infusion of cash means that we will be able to weather this downturn and have the capital to come back and invest and bring micromobility to more cities when we do come out of this COVID-19 crisis. And I think that it's a big bet for Uber, and it's a big bet for a lot of our early investors who all came in on this major round.
Wayne, you worked at Uber for 5 years. You were Dara Khosrowshahi's chief of staff. In fact, we last spoke when you were working at Uber. Curious about them offloading Jump to you. If it wasn't making sense for them, why does it make sense for Lime?
Yeah, I think there's a couple things. One is that I actually see this as Uber making a big bet in micromobility. They're leading around up to $170 million. And then what they're doing is they're bringing their Jump assets onto the Lime platform, where we have a leading position in the world of micromobility. They're combining forces with the winner, the micromobility platform, and they're going to get access to the same types of scooters and bikes that matters to the platform. It's a true win-win. All the access to the products, and investment into a platform that has is emerging as the winner in this space.
Okay, but is it a win-win? I mean, you have retreated from a dozen markets since the beginning of the year. You've paused or wound down the business in other markets, all, as I understand it, but South Korea. I mean, when are you planning to reopen, and what does that look like given the uncertainty here?
We've actually relaunched in about a dozen or so cities around the world, and the numbers we're seeing in places that are exiting shelter in place is really remarkable. And not only that, I actually think that as people exit COVID-19, people are going to be looking for a safe way to move around the city. And micromobility is open air, single passenger. If you want to move around a city while observing social distancing, there's no better mode of transportation than micromobility. And we're seeing that in the markets where we relaunched. There's two, Korea, where, as you mentioned, we've been in Seoul this whole time. Korea, one of the harder hit places by COVID-19. Seoul is hitting all-time high trips numbers today. In the United States, where we relaunched a bunch of cities, we're seeing trips that are twice as long. And what we're seeing is that people are taking scooters from their home all the way to work. I actually think that as we exit the shelter in place, it is a huge opportunity for micromobility. People are going to rethink how they move around their cities. And because we're still a relatively small part of the transportation mode, even if 1% of the people go from however they're moving around today to micromobility, it could 3 or 4 or 5x the overall marketplace for scooters and bikes.
So what's your plan to keep scooters safe, to clean the scooters? I mean, obviously you're having multiple people ride these things. I mean, I know this is something you probably never thought you would have to think about, but it is very relevant. How do you ensure riders that this is a safe option?
Absolutely, that's a great question. We've overhauled our warehouse operation. We brought in experts to think about how do we make sure that it's safe. We sanitize every scooter that comes in, we clean it, we put it out there to make sure that when it's out, leaves our warehouse, it is in perfect condition. That said, I think as passengers use our scooters, we are asking everyone to observe local guidelines. And the key thing is there are the handlebars. Wash your hands, make sure you don't touch your face. But the number one way COVID-19 is being spread is human to human contact. And when you're on a scooter and a bike, you're by yourself. You're open air, single passenger. And if you look at scooters and bikes relative to any number of transportation, I would say it is probably one of the safest ways to move around. And we're seeing that in the markets we're opening back up. It's not just our old riders coming back in a very quick way. New riders who probably never really gave scooters and bikes a chance are downloading our apps and trying it because they want to move around in a safe way. And they're really seeing micromobility as a way to solve some of their transportation concerns.
Many companies are reinventing the way they do business. I mean, do you see other opportunities now? What are you, throwing around the room in terms of your brainstorming sessions about what you can do differently to meet the needs in this new world? Might Lime get into food delivery, for example?
Yeah, I actually think the biggest opportunity for Lime is actually going out there and telling the story of micromobility. The vast majority of people have never taken Lime before, and we're all of us are asking, how does our life change in quarantine, in the world of COVID-19? And we see people delivering more groceries, working out at home. I think one of the key ways people are going to say is, if I don't want to be next to somebody, if I want to be traveling while observing social distancing, how do I do that? And how do I do that in a cheap way? Maybe I cannot go afford a car. Lime and our scooters and bikes is a cheap, it is a safe, and it is a much more environmentally friendly alternative. I actually think the key thing we got to do right now is stay focused on micromobility. This is a moment for micromobility. People are coming out and they're going to be considering this. And one last fact, if you actually look at the numbers out of China, where they're starting to come back, what they're seeing is that the e-bike business is exploding. It's exploding because people are making this calculation and they're saying that this is a great way to move. And one last thing I'll say is, if you look at the way cities have changed, Paris just announced last week they're going to put in 650 kilometers of new bike lanes. Milan announced they're going to put in 50 plus kilometers of bike lanes. New York passed a bill that's going to legalize scooters. Cities are also recognizing the value of micromobility, and they're changing the laws, changing the infrastructure to meet this moment.
Now, leading into this, this latest round of funding, I believe, values Lime somewhere on the order of $500 million, which is less than half of what the latest fundraising round valued you at last year, closer to $2.5 billion. And investors have been less optimistic about your business model, given how unprofitable it has shown to be thus far. Is this just a smaller business opportunity? I mean, certainly you see a business opportunity here, but is the opportunity now smaller than what maybe you thought it was a year ago?
I don't think so at all. In fact, I think the opportunity is bigger than ever. We are coming in at a lower valuation, but I'll say this, which is, we're not the only company in this moment in our world, this unprecedented moment, that is facing a lower valuation. The more important thing, though, is that this round of funding is going to be enough for us to weather whatever storm is ahead of us, and for us to double down into micromobility. I think you're asking about profitability. One of the things that Lime has been really focused on is, how do we build a business that's profitable? We were actually improving our profitability every single month going into the winter. We have a very seasonal business. February is our lowest revenue month. We actually hit our highest margin in our history, and we were just about to become a profitable company, and then COVID-19 hits. What this funding is going to allow us to do is to actually replay that, our 2020 playbook. And I have every confidence that with this new funding, Lime is going to be profitable and cash flow positive in 2021.
Interesting. Okay. Now, given the Uber relationship and, of course, the fact that you worked there for many years, do you see more synergies with Uber, more opportunities to partner and work together?
I do. I've learned so much from my time working for Dara, and one of the things that Dara talks a lot about is the platform strategy. How do we ensure Uber is not just doing ride sharing, but it's a platform for all forms of transportation from point A to point B. And as part of this investment, it's also us deepening that connection. You're going to be able to find Lime scooters and jump bikes on the Lime app, as well as on the Uber app globally. And we're going to be deepening that relationship over time. And I think that partnership is both a huge sign of Uber's trust and confidence in Lime, and it's also going to be a huge benefit for consumers.
You've already had a couple of significant rounds of layoffs so far this year. Will we see more layoffs, furloughs, as this crisis continues?
Yeah, and Emily, it's been a really tough, I think, year for Lime. Certainly, as somebody who had to say goodbye to a lot of good friends who worked at Lime, it's not been easy. And I know we're not the only company going through a lot of hard choices this year. I do not, at current, based on this new round of funding, expect that we're going to have any new layoffs at Lime. But I'll say this, which is we take these things very seriously, and I think that as we look to the future, our goal and our hope is that this funding will get us to profitability, and that we wouldn't have to make some of these hard choices similar to what we had to make earlier this year.
And then what about the competition? I mean, there were just so many different companies betting on scooters, and we had to believe that not all of them would survive. I mean, do you see, the consolidation is already happening, do you see even more consolidation, and what does that look like?
I definitely do. I think I think 2020, 2021 is going to be a year of consolidations. We've had a lot of scooter companies get funded. I think that's a great thing. Competition is a great thing. But as COVID-19 is creating, it's also creating clarity. Lime is by far the biggest micromobility provider in the world. We are 2 or 3 times bigger than our competitors. And now with Jump on the platform, we're going to be even bigger. And so when I look at the micromobility space, one of the key things is that I think 2021 is going to be clarifying. Not only are we going to be one of the only companies with the funding to compete, we're going to have the biggest platform. We're going to have the support of Uber and all their force behind us. We have an integration with Google Maps that nobody else has, and we have I would say the best brand and the best hardware, including I would say the best e-bike hardware from Jump, which we're incredibly excited to operate and scale. They've really done a great job there at Uber and Jump. All those advantages are going to be compounding, and I actually see 2021 as a big year. Micromobility is going to start clarifying, and Lime is emerging as the winner.
All right, Wayne Ting, CEO of Lime, good to talk to you. We'll be watching to see how things play out, and you in your new role. Thank you so much for joining us.
Thank you for having me.
All right, coming up, what is a car maker to do when it can't make cars? Tesla is currently not making any cars around the world at this very moment. We'll tell you why next. This is Bloomberg.
I think possessions kind of weigh you down. They're kind of an attack vector. People say, "Hey, billionaire, you got all this stuff." Like, well, now I don't have stuff. Now what are you going to do?
That's Tesla CEO Elon Musk on the Joe Rogan Experience podcast earlier today, explaining why he's going more than a little Marie Kondo, selling his possessions. He's already put 2 houses on the market. This as Tesla is currently not producing any cars around the world at this very moment. Bloomberg is reporting that Tesla has halted production at its Shanghai, China factory as well. And we know that production has also been halted at its headquarters here in California. Joining me now to discuss is the founder and partner of Seraph Consulting, Ambrose Conray. Ambrose, thank you so much for joining us. Now, we don't understand yet why Tesla's factory in Shanghai has shut down, though there is reporting that it's tied to supply issues, equipment issues. What do you think is the reason behind this?
Thank you, Emily. Tesla has a very complicated supply chain as they tried to set up this new factory in Shanghai. They've done a great job getting it set up. They got a great job getting the Chinese government to get behind them. But they've used the same suppliers that they've used for their Model 3 in Fremont, the Model Y in Fremont, and the plant in Shanghai all produce the same goods. So everything from the backseat forward is common, or has a lot of commonality in Tesla. So we've got challenges with production coming out of Mexico, where they're shut down because of COVID, production coming out of the U.S., where they're shut down with COVID, and likely that is creating a problem. You've got some parts in a car that are no-build parts. You just can't build the car without them. It's too hard to retrofit them. And you've got other parts that you can build without. They've either hit a no-build part or they've had an internal problem with a piece of equipment that's going to delay their ability to produce as efficiently as they want to. And they've taken a step back and realized that without this supply chain, without parts flowing from Mexico and the United States over to China, they've got a bit of a challenge to deal with right now. And they're a little bit blind in terms of when those particular suppliers will start.
This makes me wonder, Ambrose, if and when Tesla restarts production here in Fremont, California, can they just start back up? Or could they also face supply issues here, given that the pandemic is probably continuing to disrupt supply chains that we don't even realize?
Emily, I think this is sort of the canary in the coal mine for the automotive industry. What we've seen is it's just-in-time production for all of these companies. Automotive assembly plants don't hold enough goods, and they're absolutely going to see disruptions to supply, not only Tesla, but all of the OEMs will. But Tesla will see them. They're targeting right now, we're hearing a restart on the 18th. If they move to do that, we don't know for a fact when Mexico will be back up, and without a clear indication from the Mexican government in terms of when they'll be back up, it'll be very hard to see how they can actually build the vehicles they want to build in a controlled and organized way. And I know there's other work going on within the United States to get the supply base up and running, because I'm assuming that it's the supply base in the United States and Mexico that's impacting Tesla right now. I was on a call with OESA this morning where the supplier organization CEOs and others were talking, and they're really trying to closely coordinate and get things done so that there's clear regulations from the government, state and federal, in terms of what needs to be done to open back up. And I know there's a call tomorrow morning that the Mexican government is having with the same suppliers to talk about what's going to be required to get back up and running in Mexico. But you don't have enough parts or components to just run. You have to have your suppliers running.
So how would you compare Tesla's position to other automakers? You know, obviously other car makers, the factories are around the world, all subject to different issues right now. Is Tesla in a better or worse position than anybody else? Is this an opportunity for a competitor to make some gains on Tesla?
I don't think it's an opportunity for a competitor to make gains on Tesla. The Sarah team's looked at this very closely, and we think Tesla's in a very good position. They have duplicate tooling in most of these suppliers. Elon Musk had made a commitment to move a lot of the supply base to Tesla, either to sister plants of the suppliers that are running them or to other plants or suppliers in China. So I think they will be able to come back up and be able to move faster. But the entire automotive industry right now is really having a problem. ERP systems aren't set to deal with this. None of the computer systems are configured to do this. When we go in for a normal crisis project to try to figure out what's wrong, we have to run tools. We actually started a side company called Production.net that does just that. It looks at what's going on, what materials do you have, what do you need to be clear to build that particular car. And we're looking at that now and overlaying where you've got the whole supply base, where you've got COVID shutdowns. And there are a lot of red lights on our dashboard right now, simply because we don't know what's going to be happening in Mexico, and some of the states haven't produced clear regulations or clear authority for automotive suppliers to restart. And the suppliers need to restart almost a full week before the OEMs can.
Love the metaphor there. Ambrose Conray, appreciate your detailed knowledge of the auto supply chain. Thank you so much for sharing your insights with us. Coming up, we're going to be talking about Zynga Gaming, the one industry that seems to be somewhat pandemic-proof. We'll be speaking with the CEO of Zynga next. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. Headlines rolling in now from Facebook. Facebook saying in a memo to its employees, the company doesn't see opening offices until at least July 6th, and also telling employees they can work from home through the end of the year. Yes, that is until 2021. Obviously, this is really interesting. All of these companies developing different return to work strategies. And of course, we wonder what that means in terms of the impact on the business. But again, Facebook saying it doesn't expect offices to open until at least July 6th, and employees can work from home through the end of the year. Meantime, I want to move on to gaming, a business that has fared quite well in the midst of the pandemic. Zynga reported its best first quarter revenue this week, an indicator the business continuing to do well. Zynga's shares soared yesterday but lost some of those gains today. I want to bring in the CEO of Zynga now, Frank Gibeau, who joins me now on the phone. So Frank, first of all, break it down for us. Obviously, your games are social, mobile, and mostly free, which is what people want right now. What kind of trends and activity are you seeing?
Good afternoon, Emily. Yes, right now, as people are sheltering in place and dealing with the quarantine, they're really turning to games like never before. They're finding that games are incredibly engaging. It's a refuge from the stresses of the pandemic, but at the same time, and probably more importantly, it's a really compelling way to stay socially connected with friends and family. It's basically breaking down the social distancing that people are experiencing right now. Some of the trends that we saw was that in our first quarter, it really was more of a normal quarter in terms of performance. What happened towards the end of March is when you started to see the effects of the shelter-in-place start to occur. And what happened was we saw large jumps in audience, engagement, the number of times people would play the game per day, how often they would be playing, and how long. And that has carried into April very strongly. You're seeing a very large audience gain in April that is across the board, across all of our portfolios, and many of the game companies are experiencing this as well. As you mentioned, our games are free to play and largely driven by in-app purchasing, but we also have a sizable advertising business. And towards the end of March, much like what you saw with Facebook and Twitter and Google, there was a bit of a compression on the CPMs. They did drop a bit. But fortunately, in the gaming business, we were able to offset some of those losses by extending the engagement curves of our games, and therefore we saw less of an impact in our advertising business than potentially more pure play networks.
So, Frank, there's obviously concern that the advertising business will continue to be hit hard as the economic fallout from this pandemic continues. You did bump up your outlook for the year, but not as much as perhaps some investors hope. Why do you think investors, weren't as optimistic about the results as perhaps you are?
Well, I think if you look at how we guided the year for 2020, we recognize that the second half of the year still has a lot of uncertainty relative to economic downturn, how fast shelter-in-place is lifted. And so our guidance incorporated the strong Q1 that we delivered. It also incorporated strength in Q2. But we also signaled that from a perspective of how we were going to plan the year, we were going to start to assume that the business would start to see normal engagement rates towards the second half of Q2, and that would carry into the second half. Now, that is, also a situation where if shelter-in-place lasts longer, if engagement rates stay high, obviously we would change the guidance because we would start to see that overperformance continue. But we felt that it was important to give a basis to our investors on how the second half would unfold.
Now, you've been in the gaming industry a long time. You worked at Electronic Arts for 2 decades before coming to Zynga. So you've seen a dot-com bust, you've seen a recession. How would you compare what the gaming industry is experiencing right now to, what you've seen in the rest of your career?
I frankly have never seen anything like this. I'm 50 years old now and never been through a pandemic quite like this. And the interactive entertainment business is in the right place right now to provide entertainment and an escape, frankly, for people right now. And so jumps in audience like this across the board globally is unprecedented. We've experienced economic downturns before, like 2008. And what we find is that video games is actually a very appealing source of entertainment when times are tough. If you look at the entertainment spectrum, free-to-play mobile games are very efficient. If you think about what it costs to get into a game or get into a bar or go to a ball game versus jumping into a free-to-play game and playing for hours, it's a situation where it's a very efficient way to spend time.
Now, you said on the earnings call you're considering making games for platforms beyond Snap. What other platforms are you considering, and could Zoom perhaps be one of them?
Yeah, we've been intrigued by the opportunity to provide entertainment for video-based social platforms. We're looking at ways to potentially bring some of our well-known franchises and games over to some of these new settings that are proving to be so appealing at this time. We really experienced a good run there with Snap on our Tiny Royale game. We're building more games for that platform. And I think one of the key parts of our strategy is to make sure that we're always looking at new emerging opportunities to reach audiences. New platforms are really ways to innovate new experiences, reach out to new audiences. And if you're not in a position to really capture new platform opportunities, you really run the risk of missing the next big transition. So at Zynga, we've really opened up the aperture in terms of our new product pipeline. We're experimenting with a lot of new designs that are very fast to market. And video-based social networking and communication seems like a really interesting area to invest in.
All right, Frank Chabot, CEO of Zynga. Frank, always good to have your perspective here on the show. Thanks so much for calling in. Meantime, as Frank mentioned, cloud-based communication is up. We're going to be speaking with the CEO of Vonage next. This is Bloomberg. Shares of Vonage getting a boost after the company reported its quarterly results. The cloud-based communications provider seeing a boost from the need for at-home services with everyone working from home. Joining me now is Vonage CEO Elon Mazurek on the phone. Alan, thank you so much for joining us. Of course, we last spoke a few years ago when times were different, but obviously the pandemic has in fact been good for your business. Talk about the trends that you're seeing in use.
So, tragically so, the pandemic is very good for the core of what we provide, which is cloud-based communications. What you're finding in the pandemic is two trends that are happening. One is remote work, and the other is remotely delivered services. Think like you're no longer going to go to your doctor or your school, and so you see this massive growth in telehealth, distance learning, remote fitness, and the like. We concentrate on both of those because as a cloud communications provider, as companies sent everyone home, they now are equally productive at home on their communication systems as they were formerly in the office. And we also power all these various remotely delivered services.
So that leads to the question, how does your business fare when we come out of the pandemic? Especially, you've got the president talking about reopening the economy, trying to convince more states to do so. If people return to work, what does that mean for Vonage?
So it's actually very good for Vonage. We posted an excellent Q1 and gave guidance for the year, which again reflected itself in a healthy stock price appreciation today. These trends about remote work or around remotely delivered services, in our view, are permanent. It doesn't mean people are not going to go back to the office, but in many more numbers, you're going to find companies accepting, if not encouraging, virtualized work environments. And it's not like people aren't going to go back to the doctor, but you're going to see telehealth and the convenience of it, which was already a trend pre-COVID, is going to continue to be a major trend thereafter. This really is a pivot point, in my view, within the communication space where these cloud-based solutions are really going to be the norm more versus the premise-based solutions that have existed for decades.
Your telemedicine business has seen a 2,000% increase in video demand, an 800% increase in video demand overall. I can understand that, a lot of these behaviors will remain, but the question is how much? Does it mean that for you, the benefit is somewhere in the middle?
Well, it's going to create a permanent shift. And so just take one example, telehealth. It clearly was a trend in the past. Now, at this moment, it's everything in terms of how we go see the doctor. It clearly, as we get past COVID, won't be all the ways in which people go see the doctor, but it's now becoming much more in an accepted way of being treated or diagnosed by a physician. And it's going to have more broad-based appeal. So while you see this immediate spike right now, what we expect is you're going to see this permanent shift across a larger base, which is going to be a net benefit. You're going to see the same net benefit, in our view, in the remote work notion. When offices open, at some point, most people will go back to the office. But I think we've all learned a great deal, particularly knowledge workers, about our ability to be productive virtually. And so I think you're going to see far less concentration in office and much more support for a more fully virtualized environment. Cloud communications is key
to drive that. Speaking of that, Facebook now telling employees they can work from home through the end of the year. They don't expect to reopen offices until at least early July. What's your plan for returning your employees to work? And do you see, for your own company, a return to a more hybrid form of work?
I think it is clearly going to be more of a hybrid. Now, we are a very global company now. We're 25 offices globally, literally throughout the world. The situations are different based upon the status of the pandemic in various areas of the world versus where they may be in Europe or in the United States. As we begin to open the offices, we have been very, very careful about making sure that we not only protect the physical health of our employees, but their emotional health as well. So to the extent that they're uncomfortable coming back to the office, they can continue to take their jobs from home. So the whole approach is going to be more of a hybrid than in the past, where many companies really were, sort of tough about everyone being in the office for those 8 hours a day. In our view, what's interesting about this is what we're going to find is employees are going to demand it, not just in our company, but throughout the world, because today it's working. Video interactions are just becoming a part of our everyday life right now. We're going to get accustomed to it. And so Vonage is a talent-driven organization. We compete against the major technology companies throughout the world. If those people demand and want to work in a more virtualized environment, well, we're going to have to accommodate that. We're going to want to accommodate that because we want to culturally create an environment that attracts the best talent to the organization.
All right, Alan Mazurek, CEO of Vonage. Interesting to hear your thoughts on where this all goes. Thank you so much for joining us.
Emily, thank you so
much. Coming up, we're
going
to dig back into Uber's results. Headlines have been crossing as we have been talking. We'll have Pierre Ferragu of New Street Research next. This is Bloomberg. We're continuing to get great new information from Johns Hopkins University, where they're doing research on the coronavirus. Earlier today, the professor of nursing, Jason Farley, told us they're seeing glimmers of hope, especially when it comes to hospital capacity. Take a listen.
We are seeing glimmers of hope where inpatient bed capacity is stable. We have a wonderful field hospital started by our governor who is helping to unpack the hospital from those who have less acute illness and who need to convalesce in a controlled environment. And our ventilator capacity is holding strong. So all of those metrics are glimmers of hope that we see at our health system.
Jason Farley, do genetics play a very big role in who dies from COVID-19?
I think that's an important question, and we're currently investigating a variety of different types of genetic analyses. So there's very important differences in viral genetics. So are there differences in strains? We've heard lots about strains that come from China, strains that came from Europe. So pathogenicity of the virus itself is under investigation, and those viral genetics. But more importantly is our host genetics. We as humans, what do our genes and how does our immune system respond? And so what we're seeing are evidence of individuals that may have some form of weakened immunity, may have what we call a less of a strong cytokine storm, meaning the immune system doesn't respond as briskly, and therefore they may become ill, but as a result of their immune system not responding as briskly, they actually are the ones somewhat protected in moving forward into the need for mechanical ventilation. Because when the immune system doesn't act as briskly, you're not as overwhelmed by its response. So remember, it's not the virus that actually does the bad thing, it's your immune system's response to how it responds to the virus.
But Jason, are there also disparities because of gender and race? And if there are, how can we protect the people most at risk?
Yeah, well, when we think about from a gender perspective, we are seeing data that men are at greater risk than women in terms of bad outcome. We have to pay very close attention related to there are increased cardiovascular and respiratory diseases in general. The prevalence is higher in men versus women. The same when you look at race. This has nothing to do genetically that we know of right now. This is to do with access to care, poverty, health disparities between populations. And so if you live in a community across any part of the world that in which your community hospital, for example, is a low-resource hospital, it's more of a district non-academic hospital, you may have less available intensive care beds, you may have less available ventilator capacity, you may have less options of accessing a primary care provider, and that may mean you present later to care for evaluation. And so there are many things in that question that need to be unpacked in relation to things that may influence differences in both gender and racial disparities that we are seeing with this virus.
Professor Jason Farley there of Johns Hopkins University, and of course Michael Bloomberg, the founder of the parent company of this network, is a big supporter of Johns Hopkins University. Meantime, I want to get back to Uber results. Pierre Ferragu of New Street Research joining us now on the phone. Pierre, more headlines have been rolling in on Uber. Of course, the biggest news is that they saw their first decline ever in the ride-hailing business, but of course were boosted by Uber Eats, and we see them inching closer to profitability. What are your headline takeaways here?
Yeah, thanks, Emily. So what do we read here? First of all, of course, we see how much the ride-sharing business is being hurt by the lockdowns and the shelter-in-place orders, but we see signs of a bottom, which is very encouraging. So in Texas, one of the places where the lockdowns are being released progressively, we already see a 50% recovery in rides. In Hong Kong, rides are back to 70% of their peak level before the crisis, so that's great. Then the second thing that we've seen very clearly both at Uber and at Lyft, that the cost base of these businesses reacts very well to a pullback. So at Lyft, revenues were down 6% between Q4 and Q1. Cash costs were down 9%. And at Uber, revenues were down 12%, cash costs are down 9% in ride sharing. It's very rare to have businesses where you can reduce your costs faster than your revenues, and that's very encouraging. And the one thing I take from the call tonight with Uber is that they've given us confidence that they would break even at some point in 2021, so it's not so far from here.
Now, I also want to get your thoughts on Tesla because you also cover Tesla. We learned today that the China factory has halted production as well, which means they're not producing any cars around the world given the halted production at headquarters in Fremont, California. How big a deal is this for Tesla, and how serious will this impact their ability to make cars through the rest of the year?
Yes, Emily. So that's very unfortunate. And that's very costly. You know, I think a factory like Fremont being closed and not running is a cash burn of maybe $60 million a week. That's my rough estimate. So I would assume Shanghai would be a fraction of that, but still like tens of millions of dollars a week, maybe. So that's a big deal. It means Tesla is going to have like a difficult second quarter. They're going to burn cash. But the company is very safe because they have a very strong balance sheet. They have more than enough cash at hand to go through that. And remember, these problems are going to last days, maybe weeks, or if you want to be very conservative, maybe a couple of months. It's going to be relatively short. What really matters is that on the other side of the fence, once production comes back, you have massive pent-up demand for a simple reason, which is that Tesla just introduced the Model Y. And the Model Y is more than doubling the addressable market of Tesla. And so when they can restart production, it's going to be a very easy game for them to sell all the cars they have. So you'll see them come back to profitability and to growth very rapidly. And it's more a matter of weeks or months than anything else. So nothing to really worry about.
Okay. All right, Pierre Ferragu, always appreciate your thoughts here on Bloomberg Technology. Thanks so much for calling in, and thank you so much for joining this edition of the show. Bloomberg Daybreak Australia starts now. This is Bloomberg.